Hello everyone out there. Welcome to our YouTube channel Finbuzz Learning. Here we are again back with another famous topic of finance that you guys might be knowing. Today we will be going to discuss about preference shares in detail. So let's first begin by understanding the meaning of preference shares. So, preference shares, also known as preferred stock, are the shares of a company's stock that pay dividends to shareholders ahead of regular stock. Preferred stockholders are entitled to payment from firm assets before common stockholders in the event of bankruptcy. So, common stocks often do not carry a fixed dividend, while the majority of preference shares do. Additionally, holders of preferred stock or preference shares often do not have voting rights, while the holders of common stock, or we can say equity shares, typically do have the voting rights. Now, there arises a question. So let's discuss it. What happens if you own preference shares in a firm that files for bankruptcy? So, the various security holders in a firm that declares bankruptcy will be entitled to the company's asset. The exit rights granted to those security holders in their security agreements will determine the order in which they receive their respective shares of the assets. Preference shares, for instance, will typically be paid before common shareholders since they have priority over the common shares. However, compared to corporate bonds, debentures, or other fixed income assets, preference shares will typically have a lesser priority. Now, coming to the types of preference shares. So, there are multiple types of preference shares. To begin with, we will be discussing cumulative preference shares first. So, shareholders who own cumulative preference shares have the right to collect dividends for years in which they were not paid because of inadequate profits. For instance, if a business does not produce enough profit in a given year, it does not distribute any dividends to its shareholders in that particular year, but instead distributes cumulative dividends as arrears in the following year. So the next type is non-cumulative preference shares. So non-cumulative shareholders will only be paid dividends when a company earns a profit. In contrast, if the business is losing money, shareholders won't receive any dividend payments and won't be able to make a claim for back dividend payments in any subsequent fiscal year. Now, the next type of preference share is redeemable preference shares. As the name implies, the firm is required to redeem these shares within the given duration and at a predetermined price. The memorandum makes clear the price and window of time within which these shares may be redeemed. The next one is non-redeemable preference shares. So, shares that are redeemable by the company are known as non-redeemable preference shares or irredeemable preference shares. Even though Indian firms are not allowed to issue irredeemable or non-redeemable preference shares, the company can only redeem these shares when company gets wind up. Coming to the next type of preference share, which is participating preference shares. So, once the company has paid the other shareholders, participating shares have the right to share in any remaining profits made before the company is liquidated. Participating preference shareholders are entitled to dividends and a share of the company's additional profit. The next type of preference share is non-participating preference shares. So, non-participating preference shares have the right to receive the predetermined dividends that the company offers, but they have no right to partake in the additional profit that the company makes. Now, coming to the next type, which is convertible preference shares. Well, the Memorandum of Association states that these shares can be easily converted into equity shares at a set price and before a certain time. Investors choose this kind of shares because they can gain from two things. One is a dividend the company offers, and the other is the returns one could receive if the stock value increases. Now, the last type of preference share is non-convertible preference shares. So, there is no conversion of these shares into equity shares. However, they continue to enjoy all other preferences enjoyed by preference shareholders, such as fixed dividend and first claim to the asset of the company in the event of a liquidation. Now, let's discuss the advantages of preference shares. So, the first benefit of preference share is appeal to cautious investors. So, investors who seek a certain level of capital protection and a predictable return can readily sell preference shares. The next benefit is no obligations for dividends. So, if a company's profits in a given year are insufficient, it is not required to pay a dividend on preference shares. In the case of cumulative preference shares, it may potentially delay the dividend. Its finance are not put under any ongoing strain. The next advantage is no interference. So, preference shares often do not have voting privileges, as a result of which a business can raise money without losing control. Equity holders continue to have sole authority over the business. Now, the next benefit of preference share is trading on equity. So, the dividend on preference shares is paid at a predetermined rate. As a result, the company can offer the advantages of trading on equity to the equity shareholders. The next benefit is no charge on assets. So, no mortgage on charge is placed on the company's assets by preference shares. The business can keep its fixed assets available for future loan raising. The next benefit is flexibility. So, for a specific time period, a firm may issue redeemable preference shares. When it is no longer necessary for the firm, the capital can be returned back. Overcapitalization is not a concern, and the capital structure is still flexible. Now, the last but not the least advantage of preference share is variety. So, depending on the requirements of the investors, different types of preference shares may be issued. To draw risk-taking and adventurous investors, participating preference shares or convertible preference shares may be issued. Let's now discuss what are the disadvantages of preference shares. Let's start with the first one, which is fixed obligation. So, prior to paying any dividend on equity shares, a defined rate of dividend on preference shares must be paid. When it comes to cumulative preference shares, where accrued dividend arrears must be paid, the burden is heavier. The next disadvantage is limited appeal. So, preference shares are disliked by daring investors. Debentures and government securities are preferred by cautious and conservative investors. A business may need to give a greater rate of dividend on preference shares in order to draw in enough investors. The next limitation of preference share is low return. So, preference shares with a set dividend become unattractive when the company's earnings are high. In most cases, preference shareholders are not entitled to partake in the company's success. Now, the next limitation is no voting rights. So, usually preference shareholders do not carry voting rights. Preference shareholders consequently have no control over how the company is run and are helpless. The last limitation of preference share is fear of redemption. So, when the company desperately needed money, the owners of redeemable preference shares may have provided money. But whenever the money market is favorable, the company may return its money. They are rudely dismissed despite the fact that they supported the business when it needed the most. So this was all about preference shares. In the next video, we will be going to discuss the difference between equity shares and preference shares. So stay tuned with us. Do like, subscribe and share the channel. Thank you and have a wonderful day ahead.